Gold has hit $4,000. Is the bull run just starting or about to crash? Picture this. Your dad bought gold in January 2024 at $2,600 an ounce. You told him he was crazy. Boomer investment, you said. Bitcoin's the future. Fast forward to today, November 2025. That gold? It's worth over $4,000. He's up 55% in less than 2 years. Your Bitcoin? Down 12% from its peak. He won't stop sending you screenshots. But here's the real question. Is your dad a genius who got in early on an epic bull run? Or did he just get lucky right before the crash? What's up, everyone? Today we're breaking down gold's insane surge past $4,000 and figuring out if this is your last chance to get rich or a trap that'll destroy portfolios. We'll use real scenarios, cut through the hype, and tell you exactly what the smart money is doing right now. Smash that like button if you want to know whether gold makes you rich or broke in 2026. Let me show you how absolutely bonkers this rally has been. Meet Jennifer, a 28-year-old teacher from Texas. In October 2024, she put $10,000 into a gold ETF because she was scared about the election and inflation. Her friends laughed. Gold was boring. Stocks were where the money was. 1 year later, that $10,000 is worth $15,500. She made $5,500 doing literally nothing. Meanwhile, her friends who bought tech stocks are basically flat for the year. Gold went from $2,600 to over $4,050 in 12 months. It hit $4,381 in October, an all-time record. Banks are now predicting $5,000 by next year. Some are saying $5,600. This is lesson number 1. The boring boomer investment just crushed almost everything else in 2025. So why is gold going absolutely crazy? 3 massive forces are colliding. Force 1. Central banks are panic buying. China, Turkey, Poland, India, they're all loading up on gold like it's the end of the world. In Q3 2025 alone, central banks bought 220 tons. That's 485 million pounds of gold in 3 months. Poland just raised their gold target from 20% to 30% of reserves and bought 67 tons in 2025. China kept buying for 9 straight months. Even tiny countries like Cambodia are stacking gold. Why? They're done trusting the dollar. For the first time since 1996, central banks now hold more gold than U.S. Treasury bonds. Think about that. They'd rather own shiny rocks than American government debt. Force 2. Big money is flooding back in. After years of ignoring gold, Wall Street institutions suddenly want in. Gold ETFs saw 222 tons of inflows in Q3 2025. That's billions of dollars of institutional money piling in. Remember Jennifer? She's not alone. Millions of regular investors are buying gold because everything else feels risky. Stocks near all-time highs, scary, real estate, overpriced, crypto, volatile as hell. Gold feels safe when nothing else does. Force 3. The world is falling apart. Massive government debt, inflation fears, wars, dollar losing dominance. This is exactly the environment where gold thrives. This is lesson number 2. When central banks and Wall Street move together, something big is happening. But here's where the story gets messy. Meet Marcus, a 35-year-old software engineer. He watched gold go from $3,000 to $4,000 and thought, I'm missing out. In October, he bought $50,000 worth at $4,350, near the peak. 2 weeks later, gold crashed 11%. His $50,000 became $44,500. He lost $5,500 in 2 weeks. Now he's paralyzed. Sell and lock in the loss, or hold and hope it recovers? This is the danger. Gold just had its biggest correction in months. and some analysts think it's just getting started. Warning sign number 1, the dollar is fighting back. When the dollar strengthens, gold usually weakens. Right now, the dollar is showing unexpected strength. Warning sign number 2, interest rates are high. Gold doesn't pay you anything. No interest, no dividends. When you can get 4 to 5% in a savings account, why hold gold? Real yields are at their highest since 2015. Warning sign number 3, technical signals say overbought. Gold's been in the overbought zone for months. Assets this overextended usually correct hard. Some analysts see a potential drop to 3,270 to 3,440, a 20% haircut from the peak. Warning sign number 4, profit-taking is accelerating. Would you cash out after 55% gains? A lot of people are. Gold just saw its biggest ETF outflow since May. This is lesson number 3. In bull markets, the people who buy at the top get destroyed in corrections. Let's talk about what could go catastrophically wrong. Scenario 1. The Fed stays hawkish. If the Fed keeps rates higher for longer, gold gets crushed. Competition for investment dollars intensifies. Money flows to bonds and savings accounts instead. Scenario 2. Dollar surge. If a crisis hits Europe or China, money floods into the dollar as a safe haven. Gold, priced in dollars, craters. Scenario 3. China implodes. China is a massive gold buyer. Their economy is already shaky. If it gets worse, demand collapses. Gold already saw 6 straight quarters of double-digit declines in Chinese jewelry demand because prices are too high. Scenario 4. Peace breaks out. Gold thrives on fear. Recently, U.S.-China trade progress caused a 3% single-day drop. If major geopolitical tensions ease, gold's safe haven premium disappears. Scenario 5. Technical breakdown. If gold breaks below $3,270, it triggers stop losses and algorithmic selling. Cascading crash. Marcus loses 30% overnight. All right, so what actually happens next? Let's look at both futures. The bull case. Gold hits $5,000 plus. Goldman Sachs, $5,055 by Q4 2026. Bank of America, $5,000. JP Morgan, $4,000 by mid-2026. These aren't random YouTubers. These are the biggest banks on Earth. Why? Central banks will keep buying 700 plus tons per quarter. 76% of central banks plan to increase gold reserves over the next 5 years. That's relentless, price-insensitive buying. Western investors missed most of the 2024 rally. If FOMO kicks in and they pile in, another massive surge happens. Jennifer, our teacher who bought at $2,600, if gold hits $5,000, her $10,000 becomes $19,200. Nearly double her money in 2 years. The bear case, 20% crash incoming. Technical analysts see support at $3,270 to $3,440. That's a 15 to 20% drop from current levels. Only 15% of professionals expect higher prices next week, while 31% forecast declines. The rally was too fast. Profit-taking snowballs into panic selling. Marcus, who bought at $4,350, watches his $50,000 shrink to $40,000. But here's the twist. UBS and ING say this correction is healthy. It shakes out weak hands, resets sentiment, and creates better entry points. The bull market continues, just after a painful reset. This is lesson number 4. Both scenarios are possible, and being on the wrong side ruins you. So what do you actually do? If you're thinking about buying now, you're buying near all-time highs. That takes guts or stupidity, sometimes both. Wait for a pullback to $3,500 to $3,800 or dollar, cost average, small amounts monthly. If you already own gold, you're up huge. Take some profits. Sell 30 to 40% if you're nervous. Let the rest ride. Don't be greedy. If you've been watching from the sidelines, a correction is probably your entry. Set alerts for $3,600 and $3,400. If it hits those levels, start buying in chunks. The smartest play? Don't try to time it perfectly. Buy small amounts regularly. If gold rips to $5,000, you win. If it crashes, you buy cheaper. You can't lose either way. Here's my take. We're in a multi-year gold bull market, but we're also overdue for a violent shakeout. The fundamentals are rock solid. Central banks are structural buyers who don't care about short-term price. Government debt is exploding everywhere. The dollar is slowly losing its dominance. These trends take years or decades to play out. But the technicals are screaming. Gold went too far, too fast. A 15% pullback wouldn't surprise me at all. It might even be healthy. My prediction? Gold dips to $3,600 to $3,800 over the next 2 to 3 months, scares everyone, then resumes climbing to $4,500 to $5,000 by late 2026. But I could be completely wrong. Markets don't care about my predictions. The key insight: gold thrives when fiat currencies lose value, governments drown in debt, and the world feels unstable. All three conditions are present and getting worse. That's a pretty compelling case. Marcus might lose money short term, but if he holds for 2 years, he's probably fine. Jennifer is already winning, and if she holds, she'll probably win bigger. So there it is. Gold at $4,000, a historic moment that's either the opportunity of a lifetime or a trap that destroys portfolios. The smart money is split. The technicals are flashing red. The fundamentals are screaming, buy. What are you doing? Buying now, waiting for blood in the streets, or staying away completely? Drop your move in the comments. I want to know what you're thinking. And if this helped you make sense of the chaos, hit that subscribe button, because we're breaking down every market move that could change your financial future. See you in the next one.